Hello everybody. Welcome to the panel. We've already done the introduction, so I'm actually going to go straight in with questions to our very knowledgeable panelists here. We're looking at how institutions are shaping the crypto world, digital asset world now. From my very far distance, it looks as if institutional investment and institutional interest has never been as high as it is now. Increasingly, the institutions big institutions are looking at wanting to get in, perhaps a little bit uncertain about the way, about some of the infrastructure that has been built up to now, and want to build their own. Let's start with that point. Tyrone, is that really how you kind of see the market now? Institutional interest has never been so high, and in what ways are people actually now getting into this market?
I mean, I think it is definitely high. I don't know if it's never been this high. I remember back to 2015 and 2016 when it was all hype, and everyone was trying to do a blockchain POC and trying to get marketing around it. I think the key difference now, though, is the work that is actually taking place is real. Mm-hmm. We're well beyond just doing proofs of concepts and trying to understand the technology and what it can do. We're now building businesses around it. I mean, Onyx within JP Morgan is a business unit of JP Morgan, right? We have commercial goals. The entire purpose of it is to create products for not only JP Morgan, but also for our clients. And we have real products in the market that are generating real revenue and real cost savings. So yes, the interest is high. I think the other difference now is the landscape has changed somewhat. Obviously there's the pre-FTX, post-FTX world. Obviously, ironically, today is the day that Sam Bankman-Fried's court case begins. And I think what has sort of come to light very clearly over the past 9 or so months is the need for that segregation of roles and responsibilities within the broader ecosystem. And so I think that's clearly a big focus that obviously traditional financial services have, but I think more and more in the crypto native space as well now.
Well, what are we talking about here when we say that shaping the digital world? On the one hand, you've got what you might call the traditional crypto world. The big story at the moment that everyone is wanting to know is BlackRock going to get a spot Bitcoin ETF? Big traditional player looking to get into one of the oldest token, an exposure to the oldest token. At the same time, you've got JP Morgan, which is what you're looking at is effectively digitization of traditional assets here. Two slightly different things, I would argue.
They are. I mean, obviously, one of the things that has happened over the past, I guess, number of years, 5 years or so, is the emergence of crypto as an asset class. Mm-hmm. I think that if you look at something like Bitcoin, that's probably, at least from my perspective, found product market fit in terms of what it's trying to be. Mm-hmm. Now, I don't think it is the payment system that it was originally proposed back when the white paper was released. But it is still an emerging asset class, and so you do have large asset managers who are looking at it as a way of allocating into it. Mm-hmm. A lot of our focus right now is on, as you said, the traditional assets. Uh-huh. I mean, these are multi-trillion-dollar markets that we think are really ripe for improving. I think I don't want to say disrupting, because there's a lot of infrastructure that exists today for valid purposes and reasons, but there is also equally a lot of inefficiency. And so our focus is really on how do we improve the traditional markets, but more importantly than just improving the traditional markets, actually creating new products, those new assets that people can now start to get access to.
Well, let's take those two pathways in turn. Mark, let's start with what you might call the institutions looking at what you might call the traditional markets. I mentioned the BlackRock and the ETF. You get the sense that actually institutions really want to trade traditional tokens as an asset class in their own right, but don't like a lot of the infrastructure, the architecture that's been built on it up to now. Not very keen on having putting your money with a bunch of 30-year-olds sat on beanbags who mix up the corporate and the personal account?
Well, there's a number of things in there. We're going through an evolution, and that evolution is this: how do we start to use these new digital technologies and blockchain to, first of all, provide a more efficient structure for traditional finance? And institutional investors have started that process. So, if you look at BlackRock, they're already starting to use blockchain where it's efficient to do so. So are other, large institutional fund managers. And there's a number out there who are leading the way. Wisdom Tree, a number of doing that. But if we then think about the sort of tokens and coins, I don't think they are an asset class in their own right, or they won't be in the future. I think some digital assets will become part of what we describe as alternatives, and some tokenization will replace existing forms of trading existing asset classes. A bond is still a bond, whether it's in token form or in its traditional form. But I think we're going to see an evolution, and I think that's going to happen at a faster and faster pace. And that the traditional finance that we all know, those rules haven't changed. What we now need to do is get the data, the system, the analytics that enables traditional finance to start being applied to digital assets in all forms.
But you don't see Bitcoin or Ethereum as a kind of a tradable class in its own right, in the same way that.
No, I think they'll become. I think they're already becoming part of the alternatives world.
Right.
But I do see tokenization will expand what we can view and currently trading in terms of alternatives, but also fixed income, equities that currently trade on public markets in security form, they will get traded in token form. It's only a matter of time.
Tony, when you're having conversations with clients, where do they sit on this issue? Traditional, we might call it traditional crypto assets, as a tradable class or a stepping stone to something else?
I think I see it as a mix. It's there are some clients who, and it is kind of very much split, right? There are some clients who are kind of very focused on kind of these, especially crypto natives, focus on this as a new alternative asset class, right? And then particularly on the traditional players, there is the kind of that investigation of how can we use this technology to kind of make it what we're doing more efficient, and that's one aspect. It's kind of interesting. I talked to a lot of these kind of like the crypto natives, and it's interesting. I think there is quite a few things that ourselves as NASDAQ as a more kind of institutional, traditional player can bring to a lot of these crypto native firms. Right. So we talked to quite a few of them, and I mean they're focused on kind of growing this as an asset class, right? And that is their core focus. For us, I mean, from some things that we can bring to support, we feel is kind of two aspects. So one is from a tech perspective,
right?
Because we've been doing this at scale for quite a while, we kind of really bring that focus upon kind of resiliency and scaling.
Right.
And this is kind of one of the things that kind of a lot of firms, kind of as they kind of grow this asset class, that they're very focused on that growth aspect, and then that resiliency aspect, the scaling aspect has come second. Right? And then one thing which I think is kind of really kind of being a big topic these days is kind of that kind of compliance regulatory aspect.
Right.
And this is, I think, going to be kind of really kind of top of mind to a lot of these players. I think in both worlds. I think in the world where we're talking about tokenization, there is already an existing kind of very thorough understanding, right? But in this kind of more kind of alternative asset kind of growing this asset class world, there is kind of still kind of like a learning phase in terms of how do we kind of grow this asset, but achieve compliance, be on the right side of regulators.
Can I just jump in with 2 points here quickly? So from my perspective, when I think about the client conversations that I have, and this might just be a function of the seat that I'm in, but 99.9% of conversations are around tokenized assets as opposed to crypto. It is a huge conversation around how to bring traditional assets on chain. And when you look at the the activity that has actually happened over the past year, you have almost every global bank, broker-dealer, or asset manager doing something either on a permission blockchain or on a public blockchain. And they're still early, you can probably call them experiments,
Sure.
they're pilots, but the intention is very clearly there. This is a technology that people think can actually be that catalyst for how it can be disrupted, how it can be changed, which is clearly what we're trying to talk about here. But the one thing that you sort of mentioned, which I have a slightly different take on, which is,
Please do.
I think you said large institutions don't like the technology that's being built. I would disagree. I think that large institutions are very enamored by the technology, and I think that there are a lot of very strong characteristics about it. There's something about a public blockchain that is ever persistent, highly redundant, always available, where you can at any point in time through a DeFi pool get a price for some asset. That's very interesting. I think some of the challenges are just around where the technology is at right now versus what regulated financial institutions need, whether that's from an AML KYC perspective or a privacy perspective or even just scalability. But the actual technology itself is very interesting.
Yeah, I agree what you're saying in terms of the key challenge, right? I think from an institutional perspective, particularly for that use case, the big challenge is not necessarily the kind of application of technology itself, but how do we apply it and retain that compliance and regulatory compliance, right? And I think there's a much greater understanding, right, of how important that step is, right, from an institutional perspective. And I think institutions are spending much more time on that step compared to some of our crypto native peers.
We're seeing that. I mean, but they've got to keep within the existing regulatory structure. So they're trying to use the technology, they're trying to tokenize, but keep within the existing regulatory structure. So in some ways, I think as regulation catches up, that will enable this market to evolve further. And I think you're right. Tokenization, I think, is the really big change, but it will take time. The current forms of sort of tokens and digital assets, people still want to understand that. They want to put that within a sort of traditional finance framework. So we've been asked, and we're delivering things like some of the taxonomy systems, so you can begin to understand where's the risks, where's the opportunities, how do I value these different technologies in a different way. So I think there's lots to do, and we're still, I think, at the beginning of this journey, but it's an exciting journey because I think it changes the financial world.
So many different ways that we can take this. So many questions coming to mind. Just to go back to something you said, Ty, just about, do customers ever say why they're not that interested in the conversation about trading traditional crypto assets, the Bitcoins, the Ethers? I mean, one thought came to mind as well, maybe the a spot Bitcoin ETF won't actually be that big a deal after all. Why the interest in tokenization and not a sort of a trading of some sort of Bitcoin type product within the wrapper of a traditional financial infrastructure, something that somebody recognizes, an ETF or what have you?
Yeah, I mean, to be clear, there is clearly interest. There is institutions who are, specifically looking to allocate into crypto. I think two things. One is, it is clearly the case that with everything that happened in the crypto space over the past 12 months, there has been a reputational hit, and some clients just do not necessarily want to be involved right now. That's both because of the fact that there is somewhat of a narrow view that maybe more of the crypto ecosystem is kind of sort of enabling fraud than what they initially wanted to believe. The other is that regulators are very, very cautious right now around crypto. And so specifically for regulated institutions, it's actually really hard to do anything in crypto. So that's the one sort of bucket, just in terms of what crypto is providing right now to clients. The other is sort of going back to the point that I made earlier, which is just the scale, right? I mean, the scale of traditional securities versus crypto it's massive, and that is really where the opportunity is, both from a revenue perspective, but also from an efficiency perspective. So I think it's just, look, I don't really know how big the crypto market can ever really be. I think Bitcoin, the fact that it's sort of maybe more like a stable coin nowadays hasn't helped institutions wanting to allocate because, you know, the days of, you know, massive returns on Bitcoin are possibly behind us for a while at least. So it's not as interesting as a sort of, you know, an alpha generating product as maybe some, you know, early stage token products are, but then you have challenges with compliance and regulatory standing of those tokens. Whereas the traditional securities world is very well understood, right? The opportunity is well understood. So
I was going to say, look, I do think Bitcoin, you know, has a future, as I do think some other digital assets have a future. I think in the short term, there's a huge reputational risk, and I think that's causing everyone, and rightly so, to be nervous. But if Bitcoin provides diversification, it performs differently to equities and bonds, then it has a future, and that's important.
So we've already touched on the subject. Inevitably, regulation comes in. The fact that traditional securities, bonds, equities, what have you, have an entire rule book for each one, and you know, and not just a rule book, but a tried and tested way of trading, clearing, settling. Everybody knows what the way it works, and the digitization of that therefore becomes a more simpler thing to understand. Is that a crucial thing? The fact that framework of regulation is already there.
I think it's the exchanges themselves are part of the problem here, in that the functions they're carrying out go beyond what a traditional exchange today could do. So in other words, they're investing as well as, you know, they're acting as an infrastructure. And I think the regulators, when the regulators step in, separate these functions out and have that properly managed, I think you will find traditional exchanges will adopt this technology. I think they're already beginning to do that. So I think that will help enormously, and I think that will clean a lot of this up. I also think we've got a challenge in the sort of the back end, because you're going to go from a T+2, T+3 to a T+0 world. So a lot of that back office and clearing and settlement, that will disappear and will get replaced. And that, I think, will bring lots of opportunities to create new products. And I think that itself will be disruptive for the market.
Tony, you see your regulation is your day job. Mark mentioned, we just talked about how you know, the clarity that brings. Does the fact that European rules, say, you know, MiCA, the fact that that's actually out there, offer that sort of clarity, and is that the thing that people sort of need as well?
I think MiCA is a fantastic example. MiCA offers, I mean, it doesn't cover everything. I mean, DeFi being one of the notable kind of exclusions, but it offers significant increased clarity from a legislative angle in terms of what is expected and required, right? And there's also, even on the clarity, and you talked about the existing traditional markets, right? It draws upon a lot of the framework of existing markets. So from a kind of like, as you said, rule book, or from a compliance professional perspective, kind of MiCA provides kind of significantly more guidance than exists kind of in most other jurisdictions. So you're seeing what's happening in the States, right, with kind of much more aggressive kind of enforcement process from SEC and CFTC. You have kind of certain places where there exist license regimes, but it is kind of unclear, kind of like how from a practical perspective, post-licensing, kind of some of the requirements may be. I think MiCA has that kind of framework. It is something that continues to be worked on. We're going to see kind of the additional requirements coming out later in the year, right? But what I believe is that additional clarity kind of gives firms kind of what they need to at least kind of know what to expect. And to kind of go back to Mark's point in terms of the separation, kind of one thing kind of MiCA does imply, and the OSCO papers recommendations earlier in the year also implied, is around this kind of separation of function. Right. And there is that, you could see that in certain regulators where there's a greater view of the kind of business function, right? And there's a greater view from a regulatory perspective the focus that you are meeting the regular requirements of the business function or the product asset class type that you are trading or offering services upon. So if you transmit money, you're obviously needing a money transmitter license. You're holding kind of funds, custody, and those aspects. And that's
a wrapper again that people know and recognise.
Exactly right. And then I think what you'll start seeing is a lot of these kind of firms start kind of breaking up is not the right word, but I think you'll see kind of firms kind of focus upon these specific functions.
Right. And the fact that you've got that clarity or regulatory clarity in the traditional market, will you always have that sort of catching up process going on in the crypto world? You said that MiCA is pretty good, but it leaves gaps. Will that always be the case with the nature of the traditional market?
I think that is the nature of regulation, just generally. Right? It always is a bit of the catch-up, right? So, and then we're seeing that even now with artificial intelligence and some of the kind of new legislation targeting artificial intelligence, that's also a bit of a catch-up as well.
But I think, so it's interesting because Phil, you're saying there is regulatory clarity for traditional assets, which is true. I think the interesting thing is that when you try and tokenize traditional assets and leverage a blockchain, there actually isn't regulatory clarity, right? It's not that we can just automatically default to the existing rules and regulations without any conversation with the regulators. Typically what actually happens is if we're looking to tokenize some asset, US Treasury, for example, or a money market fund, we have to have conversations with our regulators as to why introducing this new technology is not going to introduce risks. And so it's not the case that it's just blanket, go and do what you want, and the existing rules are going to cover you. We actually have to be very thoughtful about how we explain why the existing rules still apply and why just introducing a new technology should not actually matter. And I think that's where the conversation is sort of a little bit stuck right now, at least why things are maybe moving more slowly than what they otherwise could have, is because we have not yet got to the point where there is a general global understanding of the fact that if you are representing an asset on a new technology like a blockchain, that doesn't automatically mean that all of the regulations and rules go out the window. And so I think that we still have to get to this point where regulators are comfortable with this technology very broadly, and until we do get to that point, it's going to be slow steps along the way.
But some regulators view this as an opportunity. I mean, if we look at Hong Kong Stock Exchange, their regulators are viewing this as an opportunity. They've already authorised 2 digital exchanges. They're inviting institutions to come in and help guide them. They're certainly talking to index providers, asking for our views on what are the next steps. Singapore has made moves in this direction. We look at Germany, we look at Switzerland, look at Amsterdam. We've seen the first ETF on digital asset in Amsterdam in Europe, and that was Jacobi. So some regulators are seeing this as an opportunity, not just a threat.
And I 100% agree that. I talk to a lot of platforms, right, and they're looking at where they're looking to base. Right? And what comes up kind of very frequently in terms of how to decide where to base in Europe or elsewhere is the regulator. Is actually a key aspect of decision. And in terms of kind of what they see, one of the aspects, it's kind of like two parts in what they look for in a regulator. One is that they look for a regulator with a good reputation, right? Because a reputation actually is still very important to them. But secondly, they're looking for a regulator that they can speak to, right? That engages with them. Right, so because, and this kind of goes back to some of the things you're saying, right? It is kind of like a back and forth explanation process, right? You need to kind of like, it's something that may not necessarily you read the rule book and you apply it to the letter. You do need to be engaged and say, this is what we're going to do from a technology perspective. These is what we feel the rules that we are, an asset class we comply with, and go through that discussion.
We've already touched on how institutions increasingly see tokenization as the big market opportunity here. This is really where it's going. Perhaps Tyrone, you might be best placed to answer this. I want to really get for anyone who out there who's not really sure what this actually means. If you could, you guys at JP Morgan have kind of tokenized things within the fixed income market. Can you give us an example of something that you've tokenized, roughly how it worked, and what that actually means for not just the bank itself, but also for the customers, the investors?
Yeah, I mean, I think maybe something that people don't necessarily appreciate is how much is actually happening today in traditional finance, firms like JP Morgan. So we have a platform called Onyx Digital Assets. It's a platform for tokenizing traditional assets, like US Treasuries, mortgage-backed securities, etc. We're doing between $1 to $2 billion every day of trading of traditional tokenized assets on this platform.
So such as a treasury?
US Treasury.
So if you take it, so effectively you've got the treasury, you've got the security, and you've turned that into a token?
Yeah, tokenized representation of the US Treasury held at a tri-party agent, for example.
And that sits on a blockchain that's run by yourselves?
That's a managed service that we run. So we have a number of external clients on the platform: Goldman Sachs, DBS, BNP, a number of others who we haven't sort of been public about. Every participant on the network has their own node. Right now, it's a fully managed service that JP Morgan effectively manages. But each of these clients have access to tokenized assets, i.e. tokenized treasuries and tokenized cash.
So they're then trading the treasury on your via your blockchain?
Yeah, what they're actually doing is entering into a repurchase agreement.
Right.
So the use case and the thing that people want this specific product for is access to intraday liquidity.
Right.
So right now, JP Morgan and other banks have clients who access credit lines, right? So we have clients who come to JP Morgan. This is in the traditional world, not the blockchain world, and they want to borrow some amount of money during the day. And ordinarily, they would draw down on a credit line to be able to do that. For certain clients, from a regulatory perspective, that actually becomes costly because whilst that credit line is typically free to use, they have to prove to their regulators that in times of stress, and if JP Morgan had to withdraw that credit line, they can still meet their payments obligations. And so they have to hold assets on their own balance sheets to prove that they have reserves, which is a costly process for them. And all they're trying to do here is access some sort of intraday liquidity. They need to go and make some payment intraday.
So even though the UST is on the blockchain, if they then purchase it, legally they do actually own the UST.
Yeah, but I guess the point here is right now the way that they're accessing this intraday liquidity outside of the blockchain product is through a traditional credit line that is unsecured.
Right.
What they now are able to do is enter into a secured financing arrangement, a repurchase agreement, where they put up collateral in the form of tokenized treasuries, and then they borrow against that. And they can be very, very specific about the length of time that they actually need to borrow those funds for. So they can borrow $1 billion for 3 hours or $500 million for 5 hours, whatever the case is. And where this technology actually comes to the fore is we're able to use things like smart contracts that automate and ensure the delivery versus payment, the exchange of assets for cash, at exactly the right time. We can be very precise with the trade terms that both parties are agreeing to. They both have visibility. There's actually no back office process here. The trade is the settlement. As soon as you've actually entered into the trade and you say, I'm going to trade at 9 o'clock and I'm going to settle at 3 o'clock in the afternoon, at 9 o'clock the trade happens, the exchange of assets for cash happens, and at 3 o'clock the reverse happens. And there's no middle office or back office processing, which is the sort of the reason why this is so interesting. Access to new products, access to cheaper liquidity, access to cheaper way of actually doing business.
Yeah, I can see how that works for JPM and its clients. You don't have to, potentially there are fewer back office people, there's less money at risk on the table while settlement taking place, access to liquidity for clients. But if every bank is doing that, what's the incentive? How do you actually kind of get everyone out of the silos? JPM maybe just for example, say Citi are doing it, say Goldman are doing it. Each one is running on their own separate little silo, for want of a better word.
Yep.
How do you turn that into a big market-wide change and not something that's just really good for the bank?
Yeah, and the name of the panel is how are financial institutions evolving the market infrastructure. This is one of the ways, in fact, perhaps not exactly the most efficient way, but you're exactly right. There is a recognition that being able to offer these types of products to clients is value add. And so you do have the situation right now where a number of banks are standing up their own platforms. And by the way, a lot of that is actually somewhat of a function of where the regulatory environment is right now. Banks like JP Morgan, as a US regulated, OCC regulated bank, we're actually not able to directly use public blockchains at this point in time. And so,
because you're not allowed to permission.
Yeah, I mean, we are able to, seek a non-objection to be able to do that, but you can imagine that's a fairly lengthy process. And so the permission blockchain environment right now is the thing that we have available to us. So, going back to your point, do you just end up with all of these siloed platforms? Somewhat, but not necessarily. A lot of banks and different players are leveraging common technologies like the Ethereum stack. So all of our work within Onyx is based on Ethereum. We have Ethereum sidechains effectively. Any contract that we write is an ERC, or a Solidity written contract that will be able to be deployed onto a public blockchain. But ultimately, what you are likely going to need is some sort of connectivity between these platforms, or some sort of broader, layer one that financial institutions can actually interact with.
But this is no different from the way markets have evolved in the past. You think about it, the banks have always innovated, and they've always moved in and dealt with some of these issues and provided for those end investors and found ways around. If you think of international equities, started that way. Think of Forex, started that way. And then they've moved on to sort of public, either exchanges or platforms. So I think the same will happen here, that the banks are starting to provide a way for being able to, the end investor, institutional, to use these types of new technologies and instruments in a way which is beneficial.
But I mean, if an equity is tokenized on a public blockchain, how would that affect me as an end investor? What could I see and do that I couldn't just buy the equity myself if I buy the equity for growth or the dividend, or both. What could I get from a tokenized equity? I mean, the fixed income is one thing, but it'll always be a very wholesale institutional market. Let's think about the equities market, which is a much broader audience.
Well, first of all, they'll get a wider range of instruments, but let's take an existing. So you take Wisdom Tree, they're providing token forms of some of their ETFs, and they're finding people who want to be able to hold the token rather than the underlying ETF. That's a benefit to them. Now, some of that may be convenience, or some of that may help them in terms of reducing their sort of custodian and other costs, but you're starting to see it evolve in that way.
Okay, to use Tony's phrase, does it scale? Okay, so you've got some people wanting to hold it as a token, but holding tokens means you're responsible, or you've got to find somebody to hold the damn thing.
Not necessarily. They're custodians who can help you with
Yeah,
that.
fair enough.
So
I mean, also, equities is probably not the right place to start, right? I mean, traditional stocks are probably not the thing that you want to start tokenizing, because they work pretty well, right? I mean, you have brokerage accounts, you get access to. If you're in a developing or developed market, it's fairly easy to get access to equities. I agree, ETFs, there's definitely optimization that can happen there. The interesting things are alternative investments, right? Getting, not quite democratizing access to alts, but improving the way that they're actually processed in the back end, which ultimately could actually improve access. And then you have these newer forms of products that might not be directly applicable to the retail investor, but are very applicable to institutional investors. Yeah. This intraday repo solution that I mentioned that we're doing at JP Morgan is one. Tokenizing money market fund shares, being able to post those as collateral is another. I mean, there are a number of different examples that are much more interesting than just tokenizing Apple stock, for example.
There's a good example in Singapore where there's a small group is actually buying private assets and then tokenizing them, and then those tokens are being traded and given access to investors into what would otherwise be, private market vehicles which may be closed to them. So there's lots of applications.
Tony, is that kind of where you see the market? Or is you're nodding your head here? Huge, and that's huge, ETF marketplace.
Well, to go talk on the tokenization question that kind of Mark raised, I think there's another interesting aspect for the alternative platforms as well. Right, as I say, for equities, there's already kind of a very large, very efficient infrastructure, which Nasdaq's part of, right, for kind of buying and selling equities. Right, I think for a lot of these alternative assets, particularly these newer ones, that infrastructure is kind of much less mature, right? And some of these asset classes, from a size perspective, don't have that same size to be able to kind of scale that level of infrastructure that may be required. So what a lot of these kind of technologies could apply is eventually kind of, I'll talk about scaling from a scaling up perspective, but there's also scaling from a scaling down perspective, right? Provide the similar levels of efficiency, right, but for more niche kind of product and asset types.
Amazing. We're getting towards the end of here, but I want to ask everybody one final question. It's the same one. We talk about scale. Ultimately, the thing that will drive scale is demand. And is the demand there? And if so, what sort of timeframes are we looking at significant? That one will be able to see significant change, and to use that dreaded word, disruption in the market. I mean, is the demand and what time scale?
My view is I think the demand is there, right? I think the application is going to be kind of fairly niche, at least initially, right? I think my driver is from a regulatory perspective, right? I think from a regulatory perspective, the framework is still kind of catching up, it's still building out, right? I think as the framework evolves and grows over time, across kind of a broader set of jurisdictions, I would see kind of that kind of helping kind of like drive the eventual kind of growth, right? But that regulatory aspect at the moment is probably one of the kind of crimpers of growth in this area.
Yeah, I mean, I would say that there is definitely demand. If I look at our client pipeline, we're going to be at something like 20 to 25 clients on the platform by the end of next year. That's large banks, broker-dealers, global tier one firms who are looking to tokenize traditional assets or get access to tokenized products that have tokenized assets in them. So demand is clearly there, and I think that's because of a recognition that this technology can be really impactful and that it is coming. I mean, when we talk about how financial institutions are changing the market infrastructure, one thing is for sure is that it is changing, and it will be changed in probably multiple decades. I think that I've been doing this for almost 10 years now, and we're definitely not as far along as I thought we would be by this point in time. So I think that the timeline is elongated, but it's happening, and it will happen. I fully expect that definitely by the time I retire, everything will be on a blockchain, but that's some time away.
It would be nice to know your career has been. But does that mean, if we're talking multiple decade time, is that just the natural evolution of markets?
Somewhat, but it needs a change. It needs a catalyst. I mean, you could argue that the dematerialization of shares was just the natural evolution of markets.
Okay.
Sure, but at the same time, here you have a technology that can fundamentally change the way that people are interacting within those markets, and I think that's the interesting thing.
The final question
I
to
think
you,
it
Mark.
happened a little bit quicker than multiple decades, but I think it will take time, and none of us know for sure. I think the first area we'll see widespread use of tokens, as already described, is in that alternative space, because it's going to expand the range of alternatives, and some niche areas where there's inefficiencies, it can address those inefficiencies. I think when it starts to move mainstream, I can see bonds moving onto tokens. I can see ETFs being the first equities really starting to move into tokenization. I think as ETFs move to tokenization, I think traditional exchanges will then start to provide blockchain technology for trading in this way, because they cannot afford not to. In the same way, BlackRock is getting involved in digital ETFs. Why? Because they can't afford not to. They can see it the future. None of us can say how long it will be, but we can see the future. I think as ETFs, more of ETFs start being listed in token form as well as the current form, as you get more use of those tokens, I think it's inevitable the main exchanges will start to get involved. As they do, we'll get a proper regulated environment, and then I think we'll see growth very quickly.
Yeah, and I'll comment on that since we're talking about exchanges.
Last one, because we're right at time.
That's very true. So from a NASDAQ perspective, we're providing technology, right, for, we may not be trading kind of a lot of crypto ourselves. We're providing technology to facilitate the activity across the entire kind of exchange platform life cycle. Right, and that's our focus now, right? Where that will be eventually, I think that's a good guess.
But what's holding us all back is reputational risk. We're all nervous that because it's unregulated today, or the regulation is weak, that's holding us all back.
And we will have to leave it there on that note. Many thanks to everybody for listening. I hope you've all got something out of that. I certainly have. I'd like to thank Tony, to Tyrone, and to Mark for your thoughts. And have a good day, everybody. Thank you.
Okay, thank you.